Before we begin, please remember that I am not a licensed financial advisor, and the information provided in this video is for educational and informational purposes only. This presentation is not intended as a substitute for professional financial, legal, or tax advice. You should always consult with a qualified professional before making any significant financial decisions, especially those concerning a mortgage. Your individual financial situation is unique, and the strategies discussed here may not be suitable for your specific circumstances. The 30-year mortgage has been sold to the American public as the golden ticket to homeownership. It's the default option, the standard, the one your parents got, the one the bank pushes on you with a smile. But what if I told you it's also one of the most brilliant financial traps ever devised? A trap designed to keep you in debt, paying the bank for the entire prime of your working life. Think about it. 30 years. A child born the day you sign those papers will be out of college and starting their own family by the time you make your final payment. For 3 decades, a huge chunk of your income is siphoned off, not to build your wealth but to build the bank's. The numbers are staggering. On a typical $400,000 home loan, the 30-year mortgage holder can end up paying over $300,000 in interest alone. That's nearly the entire value of the house, paid directly to the lender, just for the privilege of borrowing their money. You're essentially buying your home twice. But what if there was another way? A path that's hiding in plain sight, an option that brokers rarely talk about because it makes them less money. It's not the aggressive, budget-crushing 15-year mortgage, and it's certainly not the 30-year debt sentence. It's the forgotten middle child of home loans, the 20-year mortgage. And it might just be the single most powerful wealth-building tool available to the American middle class. This is the sweet spot, the perfect balance between an affordable monthly payment and a supercharged path to financial freedom. By the end of this video, you will understand this powerful financial tool inside and out. We are going to completely demystify the 20-year mortgage. We'll break down the massive life-changing pros, expose the very real cons you absolutely must consider, and I will give you a clear, simple framework to determine if switching to a 20-year loan is the right move for you to save tens or even hundreds of thousands of dollars and shave a full decade off your debt. Let's be honest. The mortgage process is designed to be overwhelming. They throw a mountain of paperwork at you, filled with terms like amortization, escrow, and points. It's confusing by design. They want you to feel a little lost, a little rushed, so you just sign on the dotted line for the standard 30-year option because it has the lowest monthly payment. It looks like the safest choice, but the lowest payment often means the highest total cost. It's a classic trade-off. You're trading a slightly more manageable payment today for a decade of extra servitude tomorrow. A full 10 years where you could be investing that money, traveling, starting a business, or retiring early. Instead, you're still sending checks to the bank. Let's pull back the curtain on how this really works. It's a concept called amortization. In the early years of a 30-year loan, your monthly payment is almost entirely interest. You're barely making a dent in the principal, the actual amount you borrowed. For the first 5, 7, even 10 years, you're essentially just renting money from the bank. You're running on a financial treadmill, working hard but going nowhere fast in terms of building actual equity in your home. The bank structures it this way on purpose. They get their profit up front. If you sell the house or refinance in the first decade, they've already collected a massive amount of pure interest from you. They win. This is the fundamental problem. The 30-year mortgage prioritizes the lender's security over your wealth creation. It minimizes their risk and maximizes their long-term profit. Keeps you on the hook for as long as legally possible. Now imagine a different scenario. Imagine knocking 10 full years off that sentence. What would that mean for you? It means you own your home free and clear, while you're still young and energetic enough to enjoy it. Maybe you're 55 instead of 65. That's a decade of freedom. A decade of not having that massive mortgage payment hanging over your head every single month. That's 10 years of taking that money, that $1,000, $2,000, $3,000 a month, and putting it directly into your retirement account where it can compound and grow. The difference between being mortgage-free at 55 versus 65 isn't just 10 years. It's a completely different retirement. It's the difference between a comfortable retirement and a wealthy one. It's the difference between worrying about your finances and having true peace of mind. This is the promise of the 20-year mortgage. It fundamentally shifts the power dynamic back in your favor. Because the loan term is shorter, the bank's risk is lower. Because their risk is lower, they typically offer you a lower interest rate than a 30-year loan. It's not usually as low as a 15-year rate, but it's a significant discount. So you get a double win. You're paying off the loan faster, and you're paying it off at a cheaper rate. This combination has an explosive effect on the total interest you pay. That $300,000 in interest on the 30-year loan? The 20-year mortgage can slash that by $100,000 or more. That's $100,000 that stays in your pocket, in your investment accounts, in your family's legacy, not in the bank's vault. The monthly payment will be higher than a 30-year, of course. There's no free lunch, but it's often a surprisingly manageable increase. And that's what we're going to dive into. We'll look at the real-world numbers and show you exactly how much more it might cost per month, and how that small monthly sacrifice translates into a colossal long-term financial victory. We're going to put the 30-year, the 20-year, and even the 15-year mortgage in a head-to-head battle. We'll run the numbers on a typical American home and you'll see, clear as day, the total cost of each loan. The results will shock you. We will explore the psychology behind the debt. Why are we so conditioned to accept a 30-year timeline for our biggest purchase? We'll talk about opportunity cost. What else could you be doing with that money for that extra decade? And most importantly, we'll get practical. We'll discuss who this loan is perfect for. The young family just starting out? The established professional in their 40s looking to accelerate their path to retirement? We'll also cover who should absolutely avoid a 20-year mortgage. There are situations where the higher payment can be a genuine risk, and you need to be aware of those pitfalls. This isn't about blindly saying one loan is good and one is bad. It's about giving you the knowledge to escape the default setting, to look past the easy option, and to make a conscious, informed decision that could literally change your financial future. The banks have their standard plan for you. Today we're creating your plan. So let's get into it. To understand the difference between a 20-year and a 30-year mortgage, you first have to understand the opponent. And your opponent isn't the seller, it isn't the real estate agent, it isn't even the bank itself. Your opponent is a silent, invisible force that works against you every single day, every single hour for decades. That opponent is called amortized interest. It's the hidden price tag on the American dream. Think of a home loan this way: you're not just buying a house. You're renting money. And the rent you pay on that money is the interest. The 30-year mortgage is the longest, most expensive rental agreement the bank offers. It's designed to maximize the amount of rent they collect from you over the longest possible time. The 20-year mortgage is your first, best tool to shorten that rental agreement and slash the total rent you pay. It's about taking control of the clock. Let's make this real. Forget abstract percentages and financial jargon. Let's talk about two families. We'll call them the Millers and the Davidsons. They live on the same street. They buy identical houses at the exact same time, for the exact same price, $400,000. They both put 20% down, so they each take out a mortgage for $320,000. They even get the exact same interest rate, let's say 6.5% for this example. Everything is identical, except for one decision. One single choice they make in a sterile office, signing a mountain of paperwork. The Millers, like almost everyone else, choose the standard default 30-year fixed mortgage. It's what the lender presented first. It's what their parents did. It's what feels normal. The Davidsons, however, they've done their homework. They pause, they look at the numbers, and they choose the 20-year fixed mortgage. Now let's fast forward. Not 30 years, just to the first monthly payment. The Millers, with their 30-year loan, have a principal and interest payment of about $2,022 a month. That feels manageable, fits their budget. They're comfortable. The Davidsons, with their 20-year loan, have a higher payment. Theirs is $2,421 a month. That's $399 more. Almost $400 extra, every single month. Right now you might be thinking, the Millers made the smart choice. They have an extra $400 a month to save, to invest, to go out to dinner. And for the first few years it might even feel that way. But remember our opponent, that silent, invisible force of interest. It's working in the background. Let's pull back the curtain and see what's really happening. The Millers will make that payment of $2,022 every month for 30 years. That's 360 payments. When all is said and done, they will have paid the bank a total of $728,000 for their $320,000 loan. That means they paid over $408,000 just in interest. $408,000. That's more than the original loan amount. They bought one house for themselves and an entire second, invisible house for the bank. Now let's look at the Davidsons. Their payment is higher, yes. It's tighter. Maybe they pack their lunch more often or drive their cars a little longer. They make their payment of $2,421 every month, but not for 30 years. They do it for 20 years. That's 240 payments. At the end of their 20 years, they will have paid the bank a total of $581,000. That means their total interest paid was $261,000. Let's put those two numbers side by side. The Millers, with the lower, more affordable 30-year payment, paid the bank $408,000 in interest. The Davidsons, who chose the 20-year path, paid $261,000. That is a difference of $147,000. $147,000. That's a college education for 2 kids. That's a fleet of new cars. That's a giant head start on retirement. It's life-changing money. And it was all decided by one single choice they made on day one. The Millers gave that money to the bank. The Davidsons kept it for themselves. This is the first and most powerful pro of a 20-year mortgage: the astronomical interest savings. It's not magic. It's simple math. Because the Davidsons were paying more each month, more of their money went toward paying down the actual loan balance, the principal, right from the very beginning. In a typical 30-year loan, those early years are brutal. You're almost exclusively paying interest. You're barely making a dent in what you actually owe. It's like trying to run up a sand dune. You're moving your legs, you're sweating, but you're barely getting anywhere. The 20-year loan gives you a solid path to run on. Every single payment makes a much bigger impact on the principal balance. And because you're paying down that principal faster, the bank has less of your money to charge you rent on. You're evicting the bank from your financial life 10 years sooner. Think about what that means. The Davidsons are completely debt-free, mortgage-free, a full decade before the Millers. While the Millers are still writing that $2,000 check to the bank every month in their late 50s or 60s, the Davidsons have stopped. Their home is 100% theirs. That entire $2,400 payment is now freed up. They can dump it into retirement accounts, travel the world, help their kids, start a business. They have achieved financial freedom a decade earlier. This isn't just about saving money. It's about building wealth. Every dollar you don't pay in interest is a dollar you can put to work for yourself. The interest you pay on a 30-year mortgage is the bank building its wealth. The interest you save with a 20-year mortgage is you building your wealth. It's a direct transfer of power from their balance sheet to yours. You're building equity in your home at a supercharged rate. If you need to sell in 7 or 10 years, you'll have a much larger chunk of cash to walk away with because you've paid down so much more of the loan. It gives you flexibility, it gives you options. So, the first giant pro is clear: you save a staggering amount of money, you build equity faster, and you own your home free and clear a full decade sooner. You win the race against interest. But as we saw with the Davidsons, winning that race comes at a cost. That extra $400 a month isn't nothing. It's a real, tangible sacrifice. And it begs the question, is it always the right move? What if that $400 could be used in a better way? What if it creates so much stress on your monthly budget that it puts you at risk? The massive savings are the siren song of the 20-year mortgage, but there are rocks beneath the surface. And that's what we need to talk about next. Because making a decision based on only the best-case scenario is how financial dreams turn into nightmares. So let's pull back the curtain on the first and most obvious con of a 20-year mortgage: the higher monthly payment. This isn't just a line item on a spreadsheet. It's a fundamental change to your monthly life. It's the anchor that can either hold you steady or drag you down. Let's use that same $400,000 loan we talked about. On a 30-year fixed loan at, say, 6.5%, your principal and interest payment is about $2,528 a month. Now switch to a 20-year term. The interest rate might drop a little, maybe to 6.25%. You'd think that would help, right? But the compressed timeline is a much more powerful force. Your new monthly payment jumps to $3,151. That's an extra $623 every single month. For a year, that's almost $7,500. Over the life of the loan, it's the difference between a nice vacation and staying home. It's the difference between comfortably funding your kids' college savings and just scraping by. This is what the financial world calls a cash flow squeeze. It's the origin of the term house poor, where you have this beautiful asset, this symbol of success, but you don't have the liquid cash to live your life. Every dollar is spoken for before it even hits your bank account. Your budget has no breathing room. An unexpected car repair for $1,000 doesn't become an inconvenience. It becomes a crisis. A surprise medical bill isn't just a bill. It's a potential catastrophe that could force you to dip into retirement savings or rack up high-interest credit card debt. completely negating the interest you're so proud of saving on your mortgage. The 20-year mortgage demands a level of financial discipline and income stability that, frankly, most people can't guarantee for 2 decades straight. Life is unpredictable. People lose jobs. Industries get disrupted. Pandemics happen. The higher payment creates a higher financial hurdle you must clear every 30 days, without fail, for 240 months. And this leads us directly to the second, more insidious con, the rigidity trap. It's the illusion of control versus the reality of obligation. With a 30-year mortgage, you have a powerful tool at your disposal: flexibility. Your required payment is lower, but nothing stops you from paying more. If you want to pay it off in 20 years, you can simply calculate the 20-year payment amount and send that extra money to the lender each month, making sure it's applied directly to your principal. You get the exact same result: a paid-off house in 20 years and massive interest savings. But, and this is the critical difference, you are not obligated to make that higher payment. Imagine you and your neighbor both buy identical houses. You take the 20-year mortgage because you're disciplined. Your neighbor takes the 30-year but plans to pay it off in 20. For the first 3 years, everything is great. You both make the exact same higher payment. You feel smart. You're on the fast track. Then disaster strikes. The company you both work for has massive layoffs. Both of you are suddenly out of a job. You call your mortgage company. You tell them you're in a tough spot. They look at your loan agreement and say, "We understand, but your payment of $3,151 is due on the 1st. They don't care about your plan, your job, or your emergency fund. The contract is the contract. You are legally obligated to pay that amount. Your neighbor calls their mortgage company. They say, "I'm in a tough spot. I can't make my extra payment this month." The bank says, "That's fine. Your required minimum payment is only $2,528. Just pay that, and you'll be in good standing." In a moment of crisis, your neighbor has an extra $623 of breathing room that you don't. They have flexibility. You have a contractual chokehold. They can weather the storm by reverting to the baseline 30-year payment. You might be facing late fees, credit score damage, or even foreclosure proceedings. By choosing the 20-year mortgage, you've essentially traded away your financial parachute for a slightly faster descent. You've pre-committed to a high-stress scenario, betting that nothing will ever go wrong in your life for the next 20 years. And that is a very, very risky bet. But the biggest con, the one that separates amateur financial thinking from professional wealth-building strategy, is the silent killer known as opportunity cost. This is the one that most people completely miss because they are so laser-focused on the idea that all debt is evil and must be eliminated as quickly as possible. Opportunity cost is the value of the next best alternative that you give up when you make a choice. Every dollar you have can only be used once. When you choose to send an extra $600 a month to your mortgage company, you are simultaneously choosing not to do something else with that money. You are not investing it. You are not starting a side business. You are not using it for your kids' education. You're using it to pay down a debt that likely has one of the lowest interest rates you will ever get in your entire life. Think about it. Your mortgage might be at 6%. Your credit card is at 25%. A personal loan is at 12%. A car loan is at 8%. In the world of debt, a mortgage is what we call good debt. It's low interest, tax deductible, and secured by an appreciating asset. So, when you aggressively pay down your 6% mortgage, what is the return on your money? It's 6%. You are guaranteed to earn 6% in the form of interest you no longer have to pay. That sounds good, and it's certainly better than letting that money sit in a savings account earning 0.5%. But what if you could earn more? Historically, over the long term, the average annual return of the US stock market, like investing in a simple S&P 500 index fund, has been around 10%. This isn't a guarantee, of course. Some years are down, some are way up. But over a 20-year period, the averages have been remarkably consistent. So you have a choice. You can take your extra $600 a month and get a guaranteed 6% return by paying down your mortgage. Or you could take that same $600 and invest it with the potential to earn an average of 10%. Let's run those numbers. That extra $623 a month, paid to your mortgage, saves you about $137,000 in interest over 20 years. That's the big number everyone gets excited about. But what if you took that same $623 a month and invested it instead, for those same 20 years, and earned a conservative average of 8%? At the end of 20 years, your investment portfolio would be worth over $367,000. Let that sink in. By taking the safe route and paying off your mortgage early, you saved $137,000. By taking the strategic risk route, you could have potentially built a nest egg of $367,000. That's a difference of $230,000. You could literally pay off your remaining mortgage balance in a lump sum and still have a massive pile of cash left over. You've essentially been tricked by your fear of debt into choosing the path that builds less wealth. You focus so much on eliminating a liability that you miss the opportunity to build a much larger asset. This is the wealth-building detour that millions of Americans take without even realizing it. They reach the finish line of a paid-off mortgage, exhausted, only to find that their neighbors who took the scenic route of investing have ended up at a far wealthier destination. So let's meet these two neighbors. We'll call them the paydowns and the investors. They're identical in almost every way. Same job, same income, same savings. They even buy identical houses right next door to each other for $400,000. Both put down a healthy 20%, or $80,000, leaving them with a mortgage of $320,000. This is where their paths diverge, creating a financial gap that will widen into a chasm over the next 2 decades. The paydowns, being cautious and hearing the conventional wisdom that all debt is bad, decide to take the 20-year mortgage. They get a slightly better interest rate for it, let's say 6.25%. Their monthly principal and interest payment comes out to be $2,156. They feel proud, responsible. They've put themselves on the fast track to being debt-free. The investors next door take a different approach. They opt for the standard 30-year mortgage. Their interest rate is a little higher, let's say 6.5%. Their monthly payment is $2,022. That's $134 less than the paydowns. To most people, that doesn't sound like a life-changing amount of money. A nice dinner out, maybe a couple of streaming subscriptions. But the investors see it for what it is: a seed. Every single month, like clockwork, they take that $134 difference and they invest it in a simple, low-cost S&P 500 index fund. They're not trying to be stock market geniuses. They're just capturing the average growth of the American economy. Now let's fast forward the clock. For the first few years, the two families look pretty similar. They mow their lawns, they have barbecues. The paydowns feel a little smug, watching their mortgage balance shrink faster. They tell their friends how they'll have their house paid off a full decade early. The investors just keep quietly investing that $134 a month. Let's jump ahead 20 years. It's a massive day for the paydown family. They make their final mortgage payment. They burn the mortgage papers in a celebratory bonfire in the backyard. They are 100% completely and totally debt-free. Their house, which has appreciated over the years, is now worth, let's say, $700,000. Their net worth tied to this decision is that $700,000 of home equity. They feel like they've won the game. But what about the investors next door? On that very same day, they are still in debt. They still have 10 years of mortgage payments left. They still owe about $145,000 on their original loan. The paydowns look over the fence and feel a little sorry for them. 10 more years of writing checks to the bank. What a drag. But then, they look at the investor's brokerage account statement. Remember that tiny $134 a month? After 20 years of consistent investing, earning a historically average 9% annual return, that small stream of money has grown into a river. It's now worth over $88,000. So let's pause and take score at the 20-year mark. The paydowns have $700,000 in home equity and zero debt. Total, $700,000. The investors have $700,000 in home equity, minus their remaining $145,000 mortgage, plus their $88,000 investment portfolio. Their net worth is $643,000. At this point, you might be thinking, aha, the paydowns are ahead. They won. They're ahead by about $57,000. And they have the peace of mind of being debt-free. Case closed, right? The 20-year mortgage is the smarter choice. But this is the great deception. This is the financial mirage that tricks millions. The game isn't over. The investors still have their most powerful weapon: 10 more years of time. For the next 10 years, the paydowns have an extra $2,156 a month that used to go to their mortgage. They feel rich. Let's be generous and assume they become super disciplined and invest that entire amount every single month for the next 10 years. Meanwhile, the investors keep doing what they've been doing. They keep paying their $2,022 mortgage, and they keep investing their $134. But that $88,000 portfolio they built over the first 20 years? It's now a serious financial engine, compounding on its own. Now let's jump forward to the 30-year mark, the day the investors finally pay off their mortgage. The paydowns have now been debt-free for a decade. Their $700,000 house has appreciated more. Let's say it's now worth $900,000. And that $2,156 they invested every month for the last 10 years? At that same 9% return, it has grown into a very respectable $412,000. So, their total net worth is their $900,000 house plus their $412,000 portfolio. That's $1,312,000. They are officially millionaires. They feel fantastic. They made it. But then they look over the fence at the investors. Their house is also worth $900,000, and it's also finally paid off. But what about their investment portfolio? That little $134 a month, which they invested for the full 30 years, has now grown to $263,000. But wait, remember the real secret weapon? The paydowns only started investing their big money at year 20. The investors had a head start, and they used the bank's money, at a low fixed rate, to free up their own cash to invest earlier. Because the investors also had that extra cash flow difference between a 20-year and 30-year payment, they were able to invest more aggressively in their 401ks, IRAs, and other accounts during those first 20 years. The core of this isn't just about that tiny $134 difference. It's about the entire concept of financial leverage and opportunity cost. The money you cram into your mortgage isn't working for you. It's just sitting there, trapped in your walls, earning you a return equal to your mortgage rate. 6-point-something% in our example. The money you put in the market has the potential to earn much more. So when we run a more complete model, where the investors use their cash flow advantage for 30 years, their final portfolio isn't just a bit bigger. It's astronomically bigger. A realistic calculation shows the investor family's net worth would eclipse the paydown families by $300,000 to $400,000. Same house, same income, different strategy. One family chose the illusion of safety, the other chose the power of math. This is the brutal, hidden cost of the 20-year mortgage. It's called opportunity cost. Every extra dollar you send to your mortgage company is a dollar that cannot be invested in the stock market, cannot be used to start a business, cannot be put into your child's college fund where it can grow and compound. You are choosing a guaranteed low rate of return, your mortgage interest rate, over a historically higher, albeit more volatile rate of return in the market. It's like having a race car in your garage but choosing to walk to work every day because it feels safer. You'll get there eventually, but you'll miss out on a world of speed and efficiency. And this brings us to an even bigger, more immediate problem with the 20-year mortgage. It's not just about retirement numbers 30 years from now. It's about your life right now. All that extra money you're pouring into your house creates a massive fortress of wealth. But it's a fortress with no doors. The financial industry has a word for this. It's illiquid. Your home equity is trapped. You can't spend it at the grocery store. You can't use it to pay for a medical emergency. You can't use it to seize a once-in-a-lifetime investment opportunity. Imagine both the paydown and investor families get hit with a major life event in year 15. The primary earner loses their job. The paydowns have a ton of equity in their house, but they have very little cash. To access that equity, they have to either sell their home in a moment of crisis or take out an expensive home equity loan, which defeats the whole purpose of being debt-averse. They are, in a very real sense, house-rich and cash-poor. The investors, on the other hand, have a smaller mortgage balance, yes, but they also have a liquid investment portfolio they've been building for 15 years. They can sell some of their stocks to cover their expenses for 6 months or a year while they get back on their feet, without having to touch their home. They have options. They have flexibility. They have financial resilience. The 20-year mortgage, in its pursuit of safety, can ironically create a much more fragile and brittle financial situation. It forces you to put all your eggs in one very illiquid basket. So if the math is so clear, if the opportunity cost is so massive, and if the liquidity risk is so high, why on earth do so many people still swear by the 15-year or 20-year mortgage? Why do financial gurus preach the gospel of paying off your house as fast as humanly possible? The answer has almost nothing to do with spreadsheets and calculators. It has everything to do with a deep-seated, powerful, and incredibly expensive bug in our human software. That bug is our deep, instinctual, and often irrational hatred of debt. It's a primal fear. For our ancestors, being indebted to someone in the tribe wasn't just a financial inconvenience. It was a threat to survival. It meant you owed a favor, a resource, an obligation that could be called in at the worst possible time. It was a vulnerability. That ancient software, that deep-seated fear of being beholden to another, is still running on our modern hardware. And there is no greater symbol of modern debt in America than the home mortgage. It's the multi-$100,000 gorilla that sits on our chest for decades. So when someone presents you with a way to get that gorilla off your chest 10 years sooner, the logical, analytical part of your brain can get instantly overruled by the ancient, emotional part that screams, "Yes, get it off me. I need to be free." This is the core appeal, the magnetic pull of the 20-year mortgage. It's not a financial product, it's an emotional one. Selling a feeling. And that feeling is one of the most powerful motivators in human existence. The feeling of security. Think about the language we use. We don't say, "I've fulfilled my contractual obligation to the lender." We say, "The house is paid off." We say, "We own it free and clear." Those words, paid off, free, clear, they don't just describe a financial state. They describe a psychological one. It's a destination, a finish line. For millions of Americans, the day they make their last mortgage payment is a more significant life event than a promotion at work. It's a declaration of independence. This is why the purely mathematical argument against a 20-year mortgage often falls on deaf ears. You can show someone a spreadsheet until you're blue in the face, demonstrating how they could earn an average of 8 or 10% in the stock market versus the 3 or 4% they're saving in mortgage interest. But you're not arguing with their calculator. You're arguing with their amygdala, the part of their brain that handles fear and survival instincts. The spreadsheet shows a potential abstract gain in the future. The mortgage payment is a real, tangible, guaranteed loss right now, every single month. And the work of Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky proved something fundamental about us. We feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. This is called loss aversion. Getting rid of a guaranteed monthly loss, that mortgage payment, feels psychologically twice as good as making a potential investment gain of the same amount. Your brain isn't weighing a 4% interest rate against a potential 8% market return. It's weighing the guaranteed pain of a monthly payment against the uncertain pleasure of a future portfolio balance. And in that matchup, eliminating the guaranteed pain often wins hands down. The 20-year mortgage is the ultimate tool for loss aversion. It accelerates the process of eliminating the single biggest, most painful guaranteed monthly loss in most people's lives. It's a direct attack on the thing that causes the most financial anxiety. This brings us to the biggest, most legitimate, and most powerful pro of the 20-year mortgage: peace of mind. And we cannot understate the value of this. Financial advisors who dismiss this as emotional nonsense are doing their clients a massive disservice. Peace of mind is not nonsense. It's a priceless asset. It's the ability to sleep at night without a knot in your stomach. It's the freedom to make career choices based on passion, not just on the desperate need to make that next mortgage payment. It's the stability that holds a family together during a job loss or a medical emergency. Let's paint a picture. Imagine two identical families, the Smiths and the Joneses, both buy identical houses for $400,000. The Smiths take out a 30-year mortgage. Their payment is, let's say, $1,900 a month. The Joneses, wanting to be debt-free faster, opt for a 20-year mortgage. Their payment is higher, maybe $2,400 a month. For the first few years, the math-focused financial world would say the Smiths are winning. They're investing that extra $500 a month, building a nice little portfolio. The Joneses are just throwing that money at their house, building equity faster, but losing out on market gains. Now, imagine 5 years down the road, the economy takes a downturn. The primary earner in both families gets laid off. The Smiths have their $1,900 payment looming over their heads. They have their investment portfolio, but it's probably taken a hit in the downturn, and they're terrified to sell at a loss. Their emergency fund starts to dwindle fast. The stress is immense. Every conversation is tense. The house, their dream home, suddenly feels like a prison, a trap. Now look at the Joneses. Their situation is also stressful, but it's different. They also have an emergency fund, but their psychological position is stronger. Over those 5 years, they've paid down a significantly larger chunk of their principal. They have a massive amount of equity in their home. The $2,400 payment is a burden. but the progress they've made feels real, tangible. They might even have the option of a home equity line of credit as a last resort safety net, an option less available to the Smiths who have less equity. More importantly, they are 5 years into a 20-year plan. They are a quarter of the way to total freedom. That knowledge, that feeling of being so much closer to the finish line, provides a powerful psychological buffer against the panic. They feel more in control. In this scenario, who is truly wealthier? The Smiths with their underwater investment portfolio and high stress levels? Or the Joneses with their lower net worth on paper but a greater sense of security and control over their lives? The value of sleeping well at night is hard to quantify on a spreadsheet, but it's very, very real. This is the trade-off. Choosing a 20-year mortgage is, in essence, buying an insurance policy. You're not insuring your house against a fire. You're insuring your mind against anxiety. You are paying a premium for this insurance. That premium is the opportunity cost, the money you could have made by investing the difference. For some people, that premium is worth every single penny. For a person who is naturally risk-averse, who lies awake at night worrying about debt, forcing them into a 30-year mortgage to chase stock market returns is like telling an anxious flyer to save money by not buying travel insurance. It's mathematically sound, but humanly cruel. It ignores the very real, physical, and mental toll that financial stress can take. The 20-year mortgage provides a structured, disciplined, automated path to this security. You don't have to remember to invest the difference. You don't have to have the willpower to avoid spending that extra cash. The bank does the enforcing for you. Your higher payment is a forced savings and investment plan, with the investment being a guaranteed, risk-free return equal to your mortgage interest rate, applied directly to your largest asset. It simplifies your financial life. Pay this amount for 240 months and you're done. You're free. That simplicity is beautiful. And in a world of overwhelming complexity, simplicity has immense value. So, when we look at the pros of a 20-year mortgage, the list is short but incredibly potent. First, you build equity significantly faster, giving you more options and a greater feeling of stability. Second, you pay tens, or even hundreds of thousands of dollars less in total interest over the life of the loan. And third, and most importantly, you buy yourself 10 years of your life back. 10 years where you're not beholden to a lender. 10 years of reduced stress, increased freedom, and the profound peace of mind that comes from owning the roof over your head free and clear. This isn't just a financial calculation. It's a life calculation. But this peace of mind, this freedom, it isn't free. And understanding its true cost is where the picture gets much, much more complicated. Let's pull back the curtain on this financial choice, because every single pro we just discussed has a shadow, an opposite and equal consequence. And the biggest, most immediate consequence of a 20-year mortgage is the brute force of the monthly payment. It's higher, significantly higher. This isn't a small detail. It's the central pillar of the entire debate. To make this real, let's stop talking in hypotheticals. Let's use some hard numbers. Imagine you're buying a home for $400,000. You put 20% down, so you're borrowing $320,000. Now, let's say you lock in an interest rate of 6.5%. With a standard 30-year mortgage, your principal and interest payment would be about $2,022 a month. That's a hefty sum, no doubt. But now, let's look at the 20-year option for that exact same loan. Your monthly payment jumps to $2,423. That's a difference of $401 every single month. $400 might not sound like a life-changing amount of money at first glance. But let's put it in perspective. That's a car payment. That's a family's entire grocery bill for a week or more. That's the cost of a weekend getaway. It's the difference between saving for your kids' college and just getting by. Over the course of a year, that's nearly $5,000. Over the 20 years of the loan, it's almost $100,000 in extra cash flow that you had to pour into your house instead of somewhere else. And that somewhere else is the most important, most misunderstood part of this entire equation. This is where we have to talk about something called opportunity cost. It's a simple idea with profound implications. Opportunity cost is the value of the next best alternative you give up when you make a choice. Every time you say yes to one thing, you are by default saying no to countless others. When you say yes to that higher $400 a month mortgage payment, you are saying no to investing that $400. You're saying no to letting that money work for you. And this is where the math starts to get really, really interesting, and potentially a little uncomfortable for fans of the 20-year mortgage. Let's follow the money. In the 20-year mortgage scenario, you're paying down your house aggressively. Feels great. You're a model of financial responsibility. After 20 years, you pop the champagne. The house is yours. You own a $320,000 asset, free and clear. Fantastic. But what about the person who took the 30-year mortgage? They have the lower payment. They have that extra $401 every month. Now let's assume they are just as disciplined as you are. Instead of spending that $400, they invest it. They set up an automatic transfer into a low-cost index fund, like one that tracks the S&P 500. They do this every single month without fail. For the first 20 years while you're slaving away to kill your mortgage, their money is quietly working in the background. It's compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world, and for good reason. It's like a snowball rolling down a hill. At first it's small, picking up just a little bit of snow. But as it gets bigger, it picks up more and more snow with each rotation, accelerating and growing exponentially. That's what's happening to their $400 a month. Let's assume a historically average and frankly quite conservative annual return on the stock market of 8%. After 20 years, the same 20 years it took you to pay off your house, how much is in their investment account? Well, that $401 a month invested diligently would have grown to over $235,000. So let's pause and take score at the 20-year mark. You have a paid-off house worth, let's say, $400,000. You have zero mortgage debt. Your net worth from this asset is $400,000. The other person, they still have a mortgage. They've been paying it for 20 years, so they still owe about $157,000 on their loan. But they also have an investment portfolio worth $235,000. So their net worth from these two assets is their home value minus their debt, plus their investments. That comes out to $478,000. At the exact moment you are celebrating paying off your mortgage, the person who took the less responsible 30-year loan is almost $80,000 wealthier than you are. And it gets even crazier, because the story isn't over. You're done paying your mortgage, which is great, but they still have 10 years of payments left. However, they also have 10 more years to invest. Let's say you start investing your entire old mortgage payment of $2,423 for those next 10 years. And they continue to invest their $401 per month, while their big pot of money continues to grow. By the time their 30-year mortgage is paid off, their initial investment account, without adding much more, would have snowballed to over $500,000. Your investment account, even with your aggressive savings in those last 10 years, would be around $430,000. At the end of 30 years, you both have a paid-off house. But the person who used the 30-year mortgage as a tool and invested the difference is significantly wealthier. They leverage time and the power of the market. This is the brutal mathematical truth of opportunity cost. The money you save in interest on a 20-year loan, which is a guaranteed return equal to your mortgage rate of say 6.5%, is often dwarfed by the potential returns you could have earned by investing that money in the market, which has historically returned more than that. You are essentially choosing a guaranteed but lower return over a variable but potentially much higher return. You're choosing security over growth. Now this comes with a huge asterisk. The stock market is not a savings account. It goes up and it goes down. That 8% return is a long-term average, not a year-to-year promise. This strategy requires discipline and a stomach for risk. It requires you to not panic sell during a market crash. It requires you to actually invest the difference every month, not just spend it on lattes and Amazon purchases. The 20-year mortgage is a forced savings plan. Takes discipline out of the equation. You have to make that higher payment. The 30-year and invest strategy requires immense personal discipline. It's easy to look at that extra $400 in your checking account and think, we could really use a new car. Or, a vacation to Hawaii sounds nice. And that's where the plan falls apart for most people. But the downsides of the 20-year mortgage go beyond just the missed opportunity for market gains. It's about flexibility, or rather, the lack of it. When you lock yourself into that higher payment, you are reducing your financial margin for error. What happens if you lose your job? What if you or your partner wants to go back to school or start a business? What if you have unexpected medical bills or need to care for an aging parent? That higher mortgage payment doesn't care about your life circumstances. It is due on the first of the month every month no matter what. It makes your financial life more rigid, more brittle. A lower payment on a 30-year loan gives you options. In good times, you can pay extra on your mortgage if you want to. You can invest more. You can save for a big purchase. In bad times, you can scale back to the minimum payment, giving yourself crucial breathing room to navigate the storm. The 20-year mortgage takes that flexibility away. It demands a high level of financial performance from you for 2 straight decades, with no breaks and no excuses. This pressure isn't just financial, it's psychological. It can mean saying no to things that enrich your life, postponing travel, skimping on hobbies, putting off home improvements. It can create a feeling of being house poor, where your home, which is supposed to be a source of comfort and security, becomes a source of stress and financial strain. You own it on paper, but in many ways it owns you. The numbers on a spreadsheet are one thing. The feeling of financial pressure in your day-to-day life, that's a completely different story. And that pressure isn't just a feeling. It has a name in the world of finance. It's called opportunity cost. It's one of the most powerful, yet most overlooked, forces in our financial lives. Every single dollar you have can only do one job at a time. When you send an extra dollar to your mortgage company, that dollar cannot be used to start a business. It cannot be invested in your retirement account. It cannot be saved for your child's education. It cannot be used to take a once-in-a-lifetime trip with your family. You are choosing one path for that dollar, and by definition, you are giving up every other possible path. The core argument for the 20-year mortgage is that you're investing in yourself by paying down debt. And that's true. But is it the best investment you can make? Let's run the numbers, because this is where the true cost of the 20-year mortgage reveals itself. Imagine 2 identical families, the Smiths and the Joneses. Both buy a $400,000 house with 20% down, leaving a $320,000 mortgage. Let's say they both lock in a 6% interest rate. The Smiths, being debt-averse and wanting security, choose the 20-year mortgage. Their monthly principal and interest payment is about $2,300. The Joneses, however, choose the 30-year mortgage. Their payment is about $1,920. The difference is $380 per month. For 20 years, the Smiths diligently make that $2,300 payment. At the end of year 20, they pop the champagne. The house is theirs free and clear. They've paid a total of about $232,000 in interest over the life of the loan. A fantastic achievement. Now let's look at the Joneses. They make their lower $1,920 payment, but they are disciplined. They take that extra $380 they're not sending to the mortgage company, and they invest it. Every single month for 20 years, they put that $380 into a simple low-cost S&P 500 index fund. Historically, the S&P 500 has averaged a return of around 10% per year over long periods. Let's be conservative and say the Joneses average an 8% annual return on their investment. After 20 years of investing $380 a month, how much do the Joneses have in their investment account? They have over $220,000. Let's pause and absorb that. At the 20-year mark, the Smiths have a paid-off house and 0 mortgage payment. The Joneses still have 10 years left on their mortgage, but they also have a brokerage account worth over $200,000. But the story doesn't end there. For the next 10 years, the Smiths, now free from their mortgage payment, decide to start investing that full $2,300 a month. The Joneses, meanwhile, just keep doing what they've been doing, paying their mortgage and investing their $380. At the 30-year mark, the Smiths have been investing their hefty $2,300 a month for 10 years. Assuming that same 8% return, their investment portfolio is worth about $420,000. Not bad at all. They have a paid-off house and a nice nest egg. But what about the Joneses? Their mortgage is now finally paid off. They paid more in total interest, about $371,000. But what happened to their investment? That initial $220,000 they had at year 20? They just let it sit and grow for those next 10 years, without adding another dime. At an 8% return, that $220,000 more than doubles. It grows to over $475,000. Plus, they were still investing $380 a month for those last 10 years, which adds another $70,000. At the 30-year mark, the Joneses have a paid-off house and an investment portfolio worth over $545,000. That's over $125,000 more wealth than the Smiths, simply by choosing a different loan term and investing the difference. This is the staggering power of opportunity cost. The Smiths chose the safe path of paying down a 6% debt. The Joneses chose to leverage that same money to potentially earn 8% or more in the market. They used time and compound interest to their advantage, and in the long run they came out significantly ahead. This isn't just a hypothetical either. It's the mathematical reality of prioritizing a low-interest debt over higher-returning investments. You are essentially choosing to earn a guaranteed return equal to your mortgage rate, say 5 or 6% by paying it down. But in doing so, you are forfeiting the chance to earn the historical market average, which is significantly higher. But the cons go even deeper than just missed investment gains. Let's talk about liquidity. This is a $5 word for a very simple concept. How quickly can you get your hands on cash when you need it? When you pour every extra dollar into your home equity, you are becoming house rich and cash poor. Your net worth on paper looks great, but that net worth is trapped inside the four walls of your house. It is profoundly illiquid. Imagine you've been aggressively paying down your 20-year mortgage for 7 years. You've built up an extra $60,000 in home equity. You feel secure. Then the unexpected happens. You get laid off. Your emergency fund starts to dwindle. You need cash to pay your bills, to buy groceries, to keep the lights on, and to make your now-crushing mortgage payment. Can you walk up to your house and ask for a few bricks back? Can you scrape some of that $60,000 in equity off the wall to pay for your car repair? Of course not. To access that money, you have to either sell your home, which is a slow and expensive process, or take out a home equity line of credit or a cash-out refinance. But here's the catch. When you've just lost your job and have no income, guess what banks are least likely to give you? More debt. The very moment you need that liquidity the most is often the moment it's hardest to get. Now, contrast that with the Joneses from our earlier example. If they get laid off in year 7, they still have their investment account. It's not trapped. They can sell some shares and have cash in their bank account in 2 to 3 business days. No applications, no credit checks, no begging a loan officer. It's their money, and it's accessible. That accessibility, that liquidity, is a form of security that home equity can never provide. Finally, there's a powerful force working in the background that most people with a 30-year mortgage benefit from, perhaps without even realizing it: inflation. A long-term, fixed-rate mortgage is one of the greatest inflation hedges available to the average person. Think about it. You lock in a payment, say $2,000 a month in today's dollars. But you get to pay that debt back over 30 years with future dollars, which will almost certainly be worth less. Your salary will likely go up over 30 years. The cost of a gallon of milk will go up. The cost of everything will go up. But your mortgage payment stays exactly the same. That $2,000 payment feels significant today, but in 25 years, when the average salary is double what it is now, that same $2,000 will feel like a bargain. You are effectively paying off your loan with cheaper and cheaper money over time. When you opt for a 20-year mortgage, you are voluntarily shortening the period during which you benefit from this powerful effect. You are choosing to pay off the loan faster using more valuable present-day dollars, instead of letting inflation do some of the heavy lifting for you over the long haul. So the 20-year mortgage gives you a paid-off house faster, but at what cost? It might cost you a fortune in the market, your emergency safety net, and the single best inflation shield you'll ever have. But there's another, more personal factor at play here. One that goes beyond the numbers entirely. It's about the kind of life you actually want to live. The market, your emergency safety net, and the single best inflation shield you'll ever have. But there's another, more personal factor at play here. One that goes beyond the numbers entirely. It's about the kind of life you actually want to live. This isn't a spreadsheet decision. This is a soul-searching decision. It's a question of what freedom truly means to you. On one side, you have the 20-year mortgage. This isn't just a loan. It's a philosophy. It's for the person who feels the weight of debt not just in their bank account but in their gut. Every month when that mortgage payment goes out, it's a constant, nagging reminder that a piece of their home, their life, still belongs to the bank. For this person, the goal isn't to optimize investment returns to the third decimal place. The goal is to be unchained. Imagine 2 hikers starting a 30-mile journey. Both are given a heavy backpack. The first hiker, let's call her the fortress builder, decides she is going to power walk, to push harder than necessary for the first 20 miles. It's grueling. She's sweating more, she's more tired each night, and she's sacrificing some of the leisurely side trails the other hiker is enjoying. But at mile 20, she gets to take the backpack off. For the final 10 miles of the journey, she is completely free. She can run, she can explore, she can rest, knowing the heaviest burden is behind her. That's the 20-year mortgage holder. They are front-loading the sacrifice. They are choosing short-term financial pressure for long-term absolute freedom. This peace of mind is an asset that you can't quantify. It's the ability to sleep soundly through a stock market crash because you know no matter what happens to your 401k, your roof is yours. It's the confidence to take a lower-paying but more fulfilling job in your 50s because your single biggest expense has vanished. It's the resilience to face a sudden job loss or a medical emergency not with sheer panic, but with a calm resolve, because the financial mountain you have to climb each month has been reduced to a small hill. For the fortress builder, paying off a mortgage in 20 years instead of 30 is a guaranteed return. It's not a hypothetical 7 or 8% from the stock market. It's a guaranteed return equal to their mortgage interest rate, risk-free. Every extra dollar they throw at that principal is a dollar they are guaranteed not to pay in interest later. They are buying certainty in an uncertain world. They are building a financial fortress brick by brick. And paying it off a decade early is like installing the final unbreakable gate. The world can throw its storms, its recessions, its chaos at them. But inside those walls they are secure. The opportunity cost of not investing that extra payment is a price they are more than willing to pay for that level of profound, unshakable security. But then there's the other hiker. Let's call him the opportunity seeker. He hears the fortress builder's plan and thinks, why would I exhaust myself carrying that heavy pack for 20 miles when I don't have to? He opts for the 30-year mortgage. His journey is different. He walks at a comfortable pace from the very beginning. His monthly payments are lower, the burden is lighter. He's not as tired at the end of each day. Because his load is lighter, he has more energy, more resources, more cash flow to use along the way. He takes that extra money he's not putting toward the mortgage and invests it. He sees a beautiful river off the main path, a side business and investment opportunity, and because he has the flexibility and the cash, he can go explore it. He's using the low-interest mortgage as a tool, as leverage. He understands that the bank is lending him money at a relatively low, fixed rate, while he can potentially earn a much higher rate of return in the market over those 3 decades. He is, in effect, engaging in a form of arbitrage, borrowing cheap to invest for higher gains. His path is about growth and compounding. While the fortress builder is focused on eliminating a liability, the opportunity seeker is focused on aggressively growing his assets. He knows that the money he invests in his late 30s and early 40s has 30 years to grow. Thanks to the magic of compound interest, that small stream of extra cash from the lower mortgage payment can become a mighty river of wealth by the time he reaches retirement. He's not just building a fortress, he's building an empire. His version of freedom isn't the absence of debt, it's the presence of options. It's having a massive nest egg that gives him the choice to retire early, to travel the world, to start a foundation, or to leave a significant legacy for his children. The mortgage is just a line item in his budget, a tool he's using strategically. The psychological weight of the debt doesn't bother him, because he can look at his investment portfolio and see that his assets are growing far faster than his liabilities. He's comfortable with the calculated risk. He understands that the market has down years, but over a 30-year horizon, the odds are overwhelmingly in his favor. However, this path requires immense discipline. The temptation to let that extra cash flow get absorbed by lifestyle inflation, a nicer car, more expensive dinners, fancier vacations, is powerful. The opportunity seeker's strategy only works if he is diligent, consistently and automatically investing that difference every single month, without fail. If he doesn't, he gets the worst of both worlds. A 30-year debt and no significant assets to show for it. He's just a hiker walking slowly, but with nothing to show for it at the end. So you have to ask yourself, which hiker are you? Are you the person who will sleep better at night knowing you are obliterating your debt as fast as humanly possible, creating an impenetrable financial shelter for you and your family? Or are you the person who gets excited by the idea of using leverage and market growth to build the largest possible net worth, creating a future of abundant options? There is no right answer. There is only the answer that is right for your personality, your risk tolerance, and your vision for your life. But what if you don't have to choose? What if there's a third path? A way to get the best of both worlds? This is a strategy that financial advisors love because it combines the security of the fortress builder with the flexibility of the opportunity seeker. It's deceptively simple. You take out a 30-year mortgage, but you make extra payments on it, treating it like a 20-year mortgage. Think about it. You get the lower, required minimum payment of the 30-year loan. This becomes your safety net. If life happens, you lose your job, you have an unexpected expense, you want to start a business and need to conserve cash, you can immediately drop back to making that lower minimum payment without any penalty. You have instant financial agility. The bank can't force you to make the higher payment. But in the good months when everything is going according to plan, you voluntarily pay that extra amount, chipping away at the principal on an accelerated 20-year schedule. This hybrid approach gives you control. You're not locked into the higher payment of a 20-year loan. You have the option to pay it off faster but not the obligation. You get the psychological benefit of seeing your loan balance shrink faster. And you still save a massive amount on interest. But you retain the flexibility to divert that cash elsewhere if a better opportunity or a crisis arises. It's a financial multi-tool, perfectly adaptable to whatever life throws at you. For many people, this hybrid strategy represents the smartest, most balanced path forward. It acknowledges that life is unpredictable, and that financial plans need to be both resilient and aspirational. So now you understand the numbers, the inflation argument, and the deeply personal psychological drivers behind this choice. You know the path of the fortress builder, the path of the opportunity seeker, and the powerful hybrid strategy that blends them together. You're armed with more knowledge than 99% of homebuyers. But there's one final critical piece of the puzzle that most people overlook. A hidden trap that can make even the most well-reasoned choice the absolute wrong one for your specific situation. It's a detail buried in the fine print that can cost you thousands, and it all comes down to the specific type of loan you get. And that specific type of loan can turn your dream of accelerated homeownership into a financial nightmare. See, when we talk about a 20-year mortgage, we're usually just talking about the term, the length of time you have to pay it back. But the mortgage itself, the actual product you sign up for, comes in different flavors. Think of it like buying a car. You've decided you want a car that can go from 0 to 60 in under 5 seconds. That's your 20-year term. But are you buying a Ford, a Chevy, or a Toyota? Because the engine under the hood, the fine print in the owner's manual, that changes everything. The three most common loan types in the United States are conventional, FHA, and VA loans. Each is designed for a different type of buyer, and each has its own unique set of rules that can either supercharge your 20-year plan or sabotage it from the inside out. Let's start with the most straightforward, the conventional loan. This is the classic, the benchmark. It's what most people think of when they imagine getting a mortgage. With a 20-year conventional loan, the path is clear. You make your higher monthly payments, you build equity at a rapid pace, and if you had to pay for private mortgage insurance or PMI because you put down less than 20%, there's a clear exit ramp. As soon as your loan-to-value ratio hits 80%, meaning you own 20% of your home's value in equity, you can call your lender and request to have that PMI removed. By law, they have to automatically terminate it once you reach 78%. It's a simple, predictable system. The faster you pay down your principal with that 20-year mortgage, the faster you kill the PMI. This is the ideal scenario. It works exactly as you'd expect. But what if you can't qualify for a conventional loan? Maybe your credit score isn't quite there, or you don't have a huge down payment saved up. This is where many people turn to an FHA loan. FHA loans are insured by the Federal Housing Administration, which makes them less risky for lenders. This allows them to offer mortgages to people with lower credit scores and down payments, as low as 3.5%. On the surface, this sounds amazing. You can get into a home sooner, and you can still choose a 20-year term to build equity fast. You're combining the accessibility of an FHA loan with the wealth-building power of an accelerated mortgage term. Feels like the perfect hack, the ultimate win-win. And this is where the trap is sprung. This is the detail buried in the fine print that has cost American families billions of dollars. With an FHA loan, the insurance you pay isn't called PMI. It's called MIP, or mortgage insurance premium. And it plays by a completely different and far more punishing set of rules. Let's imagine a homebuyer, we'll call him David. David is financially savvy. He wants a 20-year mortgage to save on interest and be debt-free faster. He finds the perfect house for $400,000, but he only has $20,000 saved for a down payment, which is 5%. A conventional loan is out of reach, so his lender suggests a 20-year FHA loan. The monthly payment is high, but David can handle it. He's excited. He calculates that with his aggressive payments, he'll hit 20% equity in just under 5 years. He'll be free of that extra MIP payment and well on his way to financial freedom. 4.5 years go by. David has been a model homeowner, never missing a payment. His home has appreciated in value, and between his payments and the market, he now has over 25% equity. The day has come. He proudly calls his lender and says, "I'd like to remove my mortgage insurance premium, please. I've passed the 20% equity mark." And on the other end of the line, there's a pause. And then the loan officer delivers the devastating news. I'm sorry, Mr. Smith, but on your FHA loan, the MIP is for the life of the loan. For the life of the loan. Let that sink in. Because David put down less than 10%, that MIP payment, that extra couple $100 every single month, does not go away when he hits 20% equity. It doesn't go away when he hits 50% equity. It stays with him for the entire 20-year term, unless he sells the house or refinances. That hack he thought he found has become a pair of golden handcuffs. He is paying a premium for a 20-year loan specifically to save money on interest and get out of debt. But he is now shackled to an insurance payment that will systematically siphon away a huge chunk of those savings. Let's put real numbers to this. On his $380,000 loan, his annual MIP is likely around 0.85%. That's over $3,200 a year, or about $270 a month. David was supposed to be free of this payment in under 5 years. Instead, he's now on the hook for it for the remaining 15.5 years. That's an extra $50,000. $50,000 gone. It's a financial landmine he never saw coming, and it completely changes the math on his 20-year mortgage. The interest savings he was so proud of are now being massively offset by this parasitic fee he can't get rid of. The only way out for David is to refinance his FHA loan into a conventional loan. But that's not a simple switch. Comes with thousands of dollars in closing costs. And what if interest rates have gone up in the past 4.5 years? He could end up refinancing into a higher rate, erasing even more of his hard-won savings. He's trapped. He has to spend thousands to save tens of thousands, a painful choice born from one overlooked detail. Now, on the other end of the spectrum, you have the VA loan available to veterans, active duty service members, and eligible surviving spouses. This is, without a doubt, one of the best loan products in existence. It typically requires no down payment, and this is the crucial part, it has no monthly mortgage insurance. A borrower can get a 20-year VA loan with $0 down and never have to worry about PMI or MIP. This makes the 20-year VA loan an incredibly powerful wealth-building tool for those who are eligible. It combines an accelerated payment schedule with the complete absence of mortgage insurance, maximizing every single dollar that goes toward principal and equity. So you see, the term 20-year mortgage is dangerously incomplete. A 20-year conventional loan, a 20-year FHA loan, and a 20-year VA loan are three entirely different financial instruments. One is a straightforward accelerator. One can be a hidden trap that punishes you for the exact behavior it should be rewarding. And one is a specialized tool that offers unparalleled benefits to a select few. Ignoring this distinction is like trying to navigate a minefield blindfolded. The decision to commit to a higher monthly payment for 2 decades is already a massive one. To make that commitment without understanding the underlying mechanics of your specific loan type isn't just risky, it's reckless. It can lead you to a situation where you're working harder, sacrificing more, and paying more every month, only to discover years down the road that your savings are being devoured by a fee you thought you'd already defeated. This underscores the absolute necessity of looking beyond the interest rate and the monthly payment. You have to ask the hard questions. You have to understand the DNA of your loan. Is there mortgage insurance? What is it called? What are the specific rules for removing it on this particular loan? If the answer is it's for the life of the loan, you need to slam on the brakes and reevaluate everything. Because the entire financial case for your 20-year mortgage could be built on an illusion. You might be better off with a 30-year conventional loan, where the PMI is guaranteed to fall off, than a 20-year FHA loan where the MIP sticks to you like glue. We've now exposed the numbers, the psychological pressures, and the single biggest trap you can fall into. We've compared the different paths and seen how a simple choice of loan type can change your financial destiny. But after all this analysis, after all the pros and cons, we still haven't answered the ultimate question, the one that truly matters. How do you decide? It's time to move beyond the theory and create a concrete, personal framework for making the right choice. Because there is one final piece of the puzzle, a factor more important than interest rates, equity, or even hidden fees. It's a deeply personal variable that, once understood, will make your decision crystal clear. And that variable is you. It's your personality, your temperament, your unique relationship with money, risk, and the future. It's the answer to a question that no loan officer will ever ask you. What does financial freedom actually feel like to you? Because the answer to that question is the key that unlocks this entire decision. For decades, the debate between different mortgage terms has been dominated by spreadsheets and calculators. We obsess over amortization tables, interest calculations, and projected investment returns. And while those numbers are crucial, they only tell half the story. They tell you the what, but they completely ignore the how. How you'll feel on a Tuesday night in 7 years when the stock market is crashing. How you'll sleep knowing you have 13 years left on your loan versus 23. How you'll approach a sudden job loss or a massive unexpected medical bill. This isn't about math anymore. This is about psychology. Let's imagine two neighbors, Sarah and Tom. They buy identical houses at the same price on the same day. Sarah chooses the 30-year mortgage. Tom chooses the 20-year. According to the pure math, Sarah is the genius. Her monthly payment is significantly lower. She takes that difference, that few $100s every month, and invests it religiously in a low-cost index fund. She's leveraging the bank's money at a relatively low interest rate to, hopefully, earn a higher return in the market. She's playing the long game of wealth accumulation. She sees her mortgage not as a burden but as a tool, a cheap line of credit that allows her to deploy her capital more effectively elsewhere. Her goal is to build the biggest possible net worth by the time she retires. The debt itself doesn't bother her. It's just a number on a page, a calculated risk in a larger strategy. Tom, on the other hand, is playing a different game. Tom hates debt. He doesn't just dislike it, he feels it. It's a weight on his shoulders. The idea of being beholden to a bank for 3 decades is a source of constant low-grade stress. His higher monthly payment on the 20-year mortgage isn't just a number to him. It's a countdown timer to freedom. Every single payment feels like a victory, a tangible step toward the day he owns his home free and clear. He sleeps better at night knowing that finish line is a full decade closer. He isn't thinking about maximizing his theoretical net worth. He's thinking about minimizing his financial anxiety. His goal isn't the biggest possible number in his investment account. His goal is the profound peace of mind that comes from owning the roof over his head, with no strings attached. Who is right, Sarah or Tom? The answer is they both are. They've aligned their financial strategy with their personal temperament. Sarah is an optimizer. Tom is a securitan. And you need to decide which one you are. An optimizer sees money as a tool for growth. They are comfortable with leverage and calculated risk. The opportunity cost of paying down a low-interest mortgage faster is to them a massive waste. Why would you rush to pay off a 4% loan when you could potentially earn 8% in the stock market over the long term? The extra cash flow from a lower 30-year payment gives them flexibility. It allows them to max out their 401k, contribute to a child's college fund, start a side business, or simply enjoy a higher quality of life today. For the optimizer, financial freedom is about having the maximum amount of capital working for them at all times. It's about options, liquidity, and maximizing total net worth. The presence of debt isn't a moral failing. It's a strategic choice. A securitan, however, sees money as a tool for security. They prioritize stability and the elimination of risk. The mathematical argument for investing the difference is irrelevant to them, because it ignores the emotional and psychological reality of debt. What if the market doesn't return 8%? What if it's flat for a decade? What if you lose your job and that investment portfolio you were building is suddenly cut in half right when you need it most? The securitan wants to eliminate the single largest expense and liability from their life as quickly as humanly possible. For them, financial freedom isn't a number on a spreadsheet. It's a feeling. It's the feeling of walking into a home you own outright. It's the invincibility of knowing that, no matter what happens with your job or the economy, you will always have a place to live. That psychological return, that peace of mind, is worth far more to them than any potential gains in the stock market. So ask yourself, what keeps you up at night? Is it the fear of missing out on investment gains? Or is it the fear of a foreclosure sign in your front yard? When you imagine your future, what's the more compelling vision? A retirement account bursting at the seams, but still making a mortgage payment at age 62? Or a more modest nest egg, but the absolute freedom of zero housing debt since you were 52, giving you a full decade of dramatically lower living expenses before you even think about retiring? This is the true heart of the 20-year versus 30-year mortgage debate. The 20-year mortgage is for the securitan. Its pros are immense psychological relief, a definitive end date to your largest debt, and substantial savings on total interest. It forces a disciplined savings plan. The cons are reduced cash flow, less money for other investments, and a higher hurdle to qualify for the loan in the first place. It is a direct brute force path to owning your home. The 30-year mortgage is for the optimizer. Its pros are maximum cash flow, flexibility, and the ability to leverage a low-interest loan to build wealth elsewhere. It makes homeownership more accessible with a lower monthly payment. The cons are the staggering amount of interest you'll pay over the life of the loan, and the mental burden of carrying a large debt for 3 decades. It is a strategic path to potentially building a larger overall net worth. And of course, there is a middle ground. You can take a 30-year mortgage for its flexibility and lower required payment, but then aggressively pay it down as if it were a 20-year or even 15-year loan. This gives you the best of both worlds. The discipline of the Securitan with the safety net of the optimizer. If a financial emergency strikes, you can revert to the lower minimum payment. But this path requires immense discipline. It's easy to say you'll pay extra, but it's much harder to do it month after month, year after year, when other life expenses inevitably pop up. So, before you look at another interest rate, before you talk to another lender, sit down and have an honest conversation with yourself. Don't just run the numbers. Think about your life. What are your goals for the next 20 years? Is it to build a business? Travel the world? Raise a family? The answer changes everything. A budding entrepreneur might crave the low payments of a 30-year loan to keep business overhead low. A couple planning for kids might want the same to handle daycare costs. Someone in a stable, high-paying career who values simplicity might sprint toward the 20-year finish line. The final decision isn't written in an amortization table. It's written in your personal definition of a life well lived. The numbers are just tools to help you build that life. The greatest financial mistake isn't choosing the wrong mortgage term. It's choosing a financial strategy that is fundamentally at odds with your own personality. An optimizer trapped in a 20-year mortgage will feel constrained and resentful of the missed opportunities. A Securitan trapped in a 30-year mortgage will feel anxious and burdened by the never-ending debt. The perfect mortgage isn't the one your lender recommends, or the one your parents had, or the one that looks best on paper. The perfect mortgage is the one that aligns with your goals, your timeline, and your temperament. It's the one that helps you sleep at night, because a home is more than an asset. It's the stage upon which your life unfolds, and the right mortgage is simply the one that builds the life you actually want to live. Choose wisely.